Hey students, I thought it would be helpful if I walk you through one of the problems in Module 2 since I feel like we ran out of time this week. So I would suggest trying this on your own after reviewing the Module 2 information and then see where you get stuck and come back and watch this video where you think it makes sense. So when you go through this, this is giving us economic transactions. A through G are each economic events, and we've got to decide how it impacts these core four financial statements. Remember the balance sheet, this is what we own, what we owe, and it also has equity. Statement of cash flow, that involves cash coming in or out. The income statement, right, that's the star of the show. It's got revenues, expenses, and the difference between the two is net income. And then the statement of stockholders' equity we didn't discuss. Hopefully you looked at it in the book, but it's telling the readers of the financial statements, hey, here's everything that changed inside our equity, our retained earnings and other equity on the balance sheet. So let's start with letter A. The company issued common stock in exchange for cash and property and equipment. All right, so if we go to A, looking at that column, and let's see here. We have to put in a plus. Let's see here. If the account is an increase, we enter a 1. If it's a decrease, we enter a 2. Okay, so if I issued common stock in exchange for cash and property, remember which side of the equation I'm on. I'm the company. I'm receiving cash. So I'm going to enter a 1 in this field to represent the fact that my cash is increasing. And I'm receiving property and equipment. That is not cash, but it is an asset, so it will go up as well. Now, I've told you that the balance sheet always has to stay balanced, right? Assets minus liabilities will equal equity. So I know I'm not done after only increasing the assets. What I also need to increase is the contributed capital. That's a part of the equity section. So as people give me cash and non-cash assets, those will increase, and then my equity will increase. The accounting equation stays in balance. Let's look down. Does anything else happen? So we did get some cash in here. So we're going to have some financing cash inflows. Now they gave us this property and equipment, but did not make us pay for it. We issued stock. So I got to think on that for a minute. We'll do the check feature and see if I need to adjust anything else. On the income statement, the fact that somebody has invested in my company has no impact on the income statement. On the statement of stockholders' equity, my contributed capital has increased. Let's do a quick check. See if I've missed anything. Hooray, all green checks. Wow, this would be a way to definitely cheat the system because it's telling you right away all the places where you need to go ahead and mark that things have increased. But let's walk through them regardless. All right, B, the company paid cash for rent of office furniture, furnishings, and facilities. Okay, so my cash is going to go down, right? So I'm going to enter a 2 because I'm paying the cash. Also, let's see here, I've got cash going out associated with the fact that I've got, I'm renting this office furniture. So I'm going to put a 2 in to show that cash is going out. And then on expenses, when I pay cash for rent of office furnishings and equipment, I'm going to assume right now, because we're not to the more complex pieces, that our expenses are going to increase as a result of this, that we're going to go ahead and expense this right away. When we have expenses, what happens to retained earnings is it actually decreases. We haven't talked about retained earnings, but the important thing to know, and we'll talk more about this in week 2, is that retained earnings changes based on whatever happens on the income statement. When I have revenue, retained earnings grows. When I have expenses, retained earnings shrink. The only other thing that will change retained earnings is if I pay a dividend. Then it will shrink as well. All right, let's do another quick check. Oh, I forgot to adjust net income. Well, since I only have expenses and no revenue, then my net income must decrease, right? Because expenses are bad guys, revenues are good guys. So I don't have a good impact to my net income. We said below in the statement of stockholders' equity that the retained earnings decreased. And let's update that here and do another check. Okay, so here's a different way to think of it because I'm moving all over the place here. I'm going to try to walk you through this in a more logical manner on C. Now we've performed services for clients and immediately received cash. Remember what I said, even if we didn't receive cash, it would still be revenue, but in this case we got cash. So let's start with the impacts to cash first. We know cash goes up. I'm going to put a 1 there. So we had cash come in our operating cash flow. And that's the only impacts that I would reflect cash. Now let's think about the revenue. When revenue goes up, go to your income statement first and think about, okay, what's happening here? Well, my revenue is going up. So what has that done to my net income? My net income is going up. When net income goes up, what did I say? Retained earnings also goes up. So go back to your balance sheet and adjust for that. So you always want to update your income statement before you determine if there's anything you need to do in retained earnings. Okay, I'm going to say that again. Figure out your income statement impacts and they will tell you how to adjust retained earnings. Since we have more income as a result of the revenue, my retained earnings has gone up as well. The statement of stockholders' equity is telling the reader if there are changes in retained earnings. And yes, we know retained earnings has gone up. We did that on the balance sheet. Those two will always stay in sync. Whatever retained earnings goes up on the balance sheet, we will show it as going up on the statement of stockholders' equity. And now let's do a check. Aha, yay. So notice that I didn't update anything in the statement of cash flow associated with the revenue. Remember, cash flow statement is just about cash coming in or out. It's not necessarily connected to the income statement. So we're looking at those two pieces individually. Let's go to D. D, we performed services for clients and sent a bill. Payments due within 60 days. Okay, do we have a cash impact here? We do not. They haven't paid us yet. But they owe us money. So when somebody owes us money, we increase receivables, right? So I'm going to go to the balance sheet. I'm going to increase my receivables. That's a non-cash asset, right? So when I change that asset, let's think about this. Does that impact anything in the statement of cash flow? Does not. Haven't received the cash yet. The fact I'm recording a receivable isn't going to impact the income statement, the receivable itself. We'll get to the revenue part. Or the statement of stockholders' equity. Now let me think about the second part of letter D. Okay, we've dealt with the part where we have a receivable. Now let me deal with the part where it tells me I performed a service. Okay, I did the service so I can record revenue. So let's start with the income statement. That's always where you start with income and expense. My revenue has gone up. Remember, when my revenue is higher than expense, I'm going to have an increase in net income. And then you always come back to your balance sheet. And if my net income is up, my retained earnings is up. This increase will also be reflected on that statement of stockholders' equity. So I'll show that up as well. Let's do a check, see if I missed anything. Again, I'm in good shape. Notice again, nothing changed in the statement of cash flow because even though I'm recording revenue, since I've performed the service, no cash has changed hands yet. Let's go to letter E. The company compensated an office employee with cash as salary. Okay, again, let's look at this in two parts. We'll look at the cash first, and then we're going to look at the salary expense. Okay, cash goes down, so I'll show that as a decrease. When cash goes down, I need to come to my operating cash flow, show that as an outflow, and that cash won't impact the income statement or the equity by itself. However, the other part of this transaction tells us that we compensated an officer or an office employee with cash for their salary, so I'm going to record an expense. I would record the expense even if I hadn't paid them if that employee had worked. Okay, when we record expense, let's start on the income statement. We're going to have expense go up. When expense goes up, that means net income goes down. We're sad about that. Since net income is down, I have to go and show that retained earnings also goes down. And my statement of stockholders' equity, which is describing what happens to retained earnings also goes down. Let's do a check. Yay, okay. Last two. We received cash as partial payment on the amount owed from the client, from D. So remember, this is where we performed the service and they said, we'll pay you in the future. So, important point. I have already recorded this revenue. Just because they're handing me cash doesn't mean I re-record the revenue. I recorded it back when I performed the service. However, there's going to be always at least two components to any transaction. Let's deal with the cash first because it's the easiest to conceptualize. They hand me cash. Okay, good. Now I can show my cash increasing. And since they handed me cash, I'll increase my operating cash flow. So if they hand me cash, what else has happened? Not recording revenue. Well, I'm going to decrease that receivable that I had recorded back in letter D. So decreasing the receivable, that's a non-cash asset, has no impact on the cash flow. It has no impact on the income statement or the statement of stockholders' equity. So you can see the only time that we impact the statement of cash flow is when the cash changes hands. Last one, the company paid cash dividends. We've taken our shareholder, they've called us up, they said, hey, looks like you've been making some money, we want part of it. So we're going to give them cash. So we'll decrease our cash. That's part of a financing transaction because it involves our owners. So we'll show that outflow in the cash flow statement. Now, important note, people want to put dividends on the income statement. Dividends that I pay my shareholders do not go on the income statement. Now, if I invested in, say, Apple, and they paid me a dividend, that'd be good revenue to me. But dividends I pay my shareholders do not impact the income statement. But because, notice that we've got this outflow going out for financing, we do need to decrease retained earnings, right? Because what I said earlier is that there are three things that can change retained earnings. Revenue will increase it, expenses will decrease it, and dividends will decrease it. And so let's reflect that up on the balance sheet as well. And I'll check my answer and I'm in good shape. So if you have more questions on this, please go ahead and send me an email and we'll talk about them more in class as well.